Hi, I'm Tobias Carlisle. This is the Acquirers Podcast. My special guest today is Matthew Sweeney of Laughing Water Capital. He's a small and micro event-driven value guy. Fascinating letters. I'm going to talk to him right after this.
Tobias Carlisle is the founder and principal of Acquirers Funds. For regulatory reasons, he will not discuss any of the Acquirers Funds on this podcast. All opinions expressed by podcast participants are solely their own and do not reflect the opinions of Acquirers Funds or affiliates. For more information, visit acquirersfunds.com.
Hi, Matt. How are you?
Doing very well. Thanks for having me on, Tobias. I really appreciate it.
So let's talk a little bit first about Laughing Water. How do you characterize what you do there?
So broadly speaking, I guess the way to think about it is a concentrated small cap strategy. And concentrated for me means typically around 15 stocks. So I wouldn't say ultra concentrated where like a 5-stock portfolio or something like that. It's a reasonable degree of diversification. And in fact, mathematically, you could argue that it's too diversified, but it's the right fit for me. And it's mostly small and micro cap stocks. It's unconstrained in terms of where the documents are, but I just happen to find most of my best opportunities at the lower end of the market cap range. So that's where I spend my time. And I call it a value strategy, but of course, value means different things to different people. And I kind of think about that as a spectrum where on one hand of the value spectrum, you might have like undervalued asset plays. And on the other hand, you might have underappreciated growth. And there's a whole range of possibilities of value between those two sides. And I try to diversify across that. So there's some names in the portfolio that are undervalued on an asset basis and some that I think are underappreciated growth. The bulk of the names are kind of in the middle where I wouldn't argue that they're the best businesses in the world, but they're pretty good businesses. And they're not the fastest growers in the world, but they typically have a growth element to them. But the reason why they're really valuable is because of some sort of non-economic event or special situation type variable that allows us to, as buyers, to buy them at a price below what a reasonable business person would pay for them over time.
Did you see Dan Loeb had a comment in one of his recent letters where he said they're trying to buy compounders, but they're trying to get them as they come out of special situations? Is that sort of analogous to what you're doing?
I actually had not seen that from Dan Loeb, but that's exactly what it is. I say in the best case, we can find an underappreciated compounder at a special situation price. And that special situation can come from a variety of reasons. It's not typically the classic Greenblatt special situations where it's a spin-off or something like that. I, of course, look at those things, but even just looking statistically, we could see that spin-offs are not as successful as they once were, likely because so many people are looking at them. They tend to be much more idiosyncratic kind of one-off opportunities that come up. And they're sometimes attached to good businesses that if they're managed differently or under a different management team, have the potential to turn into compounders. But at the moment, people are looking at them and just saying, there's a problem here. There's something going on that explains the cheap price.
Do you have any examples that illustrate what your strategy is?
Yeah, I don't want to talk too much about names, but like a good example of one that's just totally idiosyncratic, I think is really interesting, is this company Whole Earth Brands. And the ticker is FREE, F-R-E-E. And if you've been reading the newspaper at all, or at least the New York newspapers, it seems like every day lately, Ron Perlman has been on the cover of the newspaper because he's having a problem with his debt stack. So if you think about Ron Perlman 2 years ago was the 47th richest person in the world. And this year, 1 week, he's on the cover of the New York Post because he's trying to sell his Hamptons estate for $180 million. And the next week, he's on the cover of the New York Post because he's trying to sell his art collection for a couple $100 million. He wound up selling his position in Scientific Games, right? I believe it was $1.5 billion. And another sale he made were two companies called Marisant and Mavco. And one of them is basically they do licorice extract. So it's a flavoring that goes into tobacco to flavor tobacco. And the other one does non-sugar sweeteners. So you could think of like the little blue packets of Equal that people put in their coffee, as well as a couple other ones that are popular European brands. And then they have some natural sweeteners like stevia-based sweeteners. Anyway, Ron Perlman also sold that. And if you just think about it from a high level, it's a pretty decent business. No one's going to wake up tomorrow and decide to change the sweetener they put in their coffee. So it's pretty dependable. But where it gets interesting is that it was bought by a SPAC. The SPAC is called Act 2 Acquisition. SPACs, of course, have a terrible track record, so a lot of people don't even look at them at this point, although I guess recently there's been a couple home runs, so people have a renewed interest. But where it gets interesting is you can look at it, and the SPAC deal was actually struck back in January, and the initial price was, I think, 575 million, if I remember correctly. And then when COVID hit, they actually wound up renegotiating the price lower on two different occasions, where the final price was actually, I think it was 440 million. And what happened basically is that Ron Perlman already had a debt problem, and then the coronavirus came, and his debt problem really got out of hand, and he was just fire selling these assets because he needed capital so bad. So that alone is just an interesting setup. I mean, it's not every day that a multi-billionaire has to liquidate his portfolio and sell things at fire sale prices. And then you can look at Ron Perlman's track record and say, you don't get to be a multi-billionaire without a pretty good batting average. So it's just more validation that these might be pretty good businesses. And then think about the way Ron Perlman runs his empire. And traditionally what's happened is he has his operating companies and they kick up cash flow to the parent company to service his debt stack. But what that means is at the company level, he's not necessarily making all the investments he should be making in order to make the business as efficient as it could be. And I think that's the case here. For example, there's two different businesses that seem to fit well together, and they had two different accounting departments and two different IT departments, two different packaging procurement groups, like very low-hanging fruit in terms of looking at this and saying, is there an opportunity here to widen margins? Because if you think about what drives business value over time, I mean, today, most people will argue it's only revenue, but that's not really true. It really should be, earnings growth and cash flow and stuff like that. But you could, of course, get to those things through growth, but you could also get to them through operational efficiency. And one of the things I think about a lot of times is which is easier, the growth, maybe. I mean, there's certainly some companies where growth is easy, but it's a pretty low bar in my mind to decide to eliminate a duplicate accounting department. I mean, that's not rocket science. And that fits well with kind of my working assumption when I'm thinking about an investment, because the base assumption is generally that I'm the dumbest person in the room. And if you could find something to explain, no, you're not actually the dumbest person in the room. The seller is the dumbest person in the room, or the most constrained. I certainly don't want to imply Ron Perlman is dumb, but the seller is under some sort of constraint where they're forced to make a non-economic decision. That's just a fantastic starting point for any kind of investment. And then layer on the opportunity for operational improvement. Like I just said, the two accounting departments, and they have some room to improve their footprint in terms of their manufacturing capacity. And then, of course, consider the people involved. So the SPAC itself, Act 2, is the second act of a guy named Erwin Simon, who previously founded Hain Celestial. And fascinating story. He started the company literally in his garage after mortgaging his apartment to finance it. And then he turned it into $2.5 billion revenue business. Now, he's not infallible by any means. You could look at his capital allocation track record and say that it wasn't always the best. Maybe he was overpaying for things, and per share value did not perfectly match business value growth. But nonetheless, I mean, just making up a number, I would bet there's less than 1,000 people in the world that started a business and took it to $2.5 billion in revenue. So at the very least, he's not a normal person to be partnering with. So you have someone like that with a fantastic track record of building a business, buying from someone like Ron Perlman, who has a known problem on his hands. And you put it together, and that's kind of a unique opportunity that the mechanical screeners can't find. And, it comes up rarely, something like that. But if you're fortunate enough to find something like that, it can really drive returns over time.
So the thesis was basically Ron Perlman he is a very good investor, famously took over Revlon in the 80s, sort of came to prominence in the 80s doing that. And there have been various books written about him. I've got some of them behind me right there. And for debt reasons, he's had to sell down some of his holdings, including houses and art, and probably some of his smaller businesses, perhaps. And he's been a little bit of an absentee landlord, using the cash flows to finance the debt rather than reinvesting in the business. And here it's transitioning to somebody who's a focused, or a management team that's going to be focused on the business, and they have a good track record in growing a business like this. And so it's basically a bet on the new management team being able to take what should be a pretty good asset and take it to another level.
Yeah, I mean, high level, that's correct. The actual management team is staying in place. It's just now there's a new a new board of directors and a chairman. So rather than Ron Perlman overseeing it, Erwin Simon is overseeing it, but the management team themselves is staying in place. And what's interesting about that is now that they're a public company, they have a different set of motivations, and they've actually been buying shares in the open market, which suggests that they are pretty happy with the way their incentives are aligned, which is always a good thing to see.
So you mentioned in your in the brochure that you sent to me that one of the things you look for is owner-operator type managers. So this certainly fits that bill. But why is an owner-operator style manager important?
Yeah, there's a couple of reasons. I mean, one is just the obvious, which is incentives. I mean, when people have skin in the game, they tend to perform better. That's not a secret. There's plenty of evidence to suggest that. I think another thing that is interesting, though, is in today's world where so much of the market is driven by index flows and ETF flows, owner-operator businesses are actually disadvantaged by the indexes because indexes are market cap weighted but float adjusted. So if you have two companies and they're exactly the same, in the real world, if the CEO or whoever of one of them owns a whole bunch of stock, you would say that's probably the better bet. But in the index world, the index would actually buy less of that business. So it's just kind of a way to skew yourself and give yourself an advantage versus the indexes, in addition to the obvious of just saying people perform better when they have skin in the game. And for me, especially with a concentrated portfolio, I want to be able to sleep at night. And a good way to sleep at night is to say, well, the guys that have all the skin in the game on the management team are probably not sleeping. They're probably up worrying all night about things that I don't even know about because I'm an outside passive minority shareholder. So it's just nice to have them shoulder some of that burden.
How did you get started as an investor, and how did you sort of transition to the point where you are now?
Yeah, so I have kind of a unique origin story. I feel like in this business, you meet so many guys that started investing in stocks when they were 12 years old. And that was definitely not me. In fact, I graduated college without having ever taken a single business class or a single accounting class or anything like that. I was a history major. And as a history major, or even before that in high school, every teacher I ever had told me that I should be a lawyer, specifically be a litigator. And I know you have a legal background.
I don't know if that's a compliment.
Well, no, I mean, I understand. But what it was, whether it's a compliment or not, was that I was the guy that if I got something wrong on a test or, a grade I thought should be better on a written paper or something like that, I would come back with my reasoning and argue, say, no, this is why it's right. This is why I'm right. You think of it's this, but I think it's this. And, there's a difference in perception there. And I think just kind of having that analytical interest in trying to find the differences in the perceptions kind of set me up for something like a litigator potentially and arguing everything. So as a history major, and then as I graduated, I actually intended to spend a year doing basically like a gap year working as a paralegal at a law firm that was run by an alumni of my school. And that was the plan, but that plan got put on hold in 2001 because that was actually starting in September of 2001, and then 9/11 happened. And that kind of changed everything for me. I grew up about a half hour outside of New York City. There were, I believe it was 26 people from my hometown were killed on 9/11, including two guys that I went to high school with. And both of those guys worked at Cantor Fitzgerald, which was, I guess for people who might not know it, I think the hardest hit, I think it was 656 people at Cantor were killed on 9/11. And they were basically more known as a bond brokerage, but they had an equity department as well. And through some connections I had with people in town and then my friends that worked there and whatnot, somebody that survived kind of tracked me down and called me and just said, look, we need help. Can you come in and help us? And I spoke with the people at the law firm and they said, of course, it was such a strange time in the world. And the law career would always be there. If I wanted to go back to law school, I could always do that. But at that moment, it felt like the right thing to do to go in and help at Cantor Fitzgerald. So my first day was, I think it was, if I remember correctly, September 18th. And I was in the disaster recovery zone in Connecticut, where prior to 9/11, there were like maybe 20 people that worked there. And when I started there were 80 people there. And there's nothing funny about it because of the circumstances, but I think a rare example where I could say my first job on Wall Street was actually building desks. And in my interview process, they were like, do you have any construction experience? And I said, I actually do have construction experience. They said, great, start building desks because there's going to be a lot more people showing up here. And that was how I got my foot in the door. After building desks, I was basically in like a middle office role on the equity trading side. institutional equity trading. And as you can imagine, when everyone in front of you is gone, you could climb the ladder pretty quickly. So within a couple months, I was actually on the trading desk in a sales trading role.
The desk that you had built.
Yeah, exactly. A sales-driven role, commission-based role, where you're calling, the best customer to think of is somebody that owns 300 stocks, has, 10 billion under management, and they trade every day because it's commission-based. Somebody like that, their churning portfolio is great for commissions. So a big part of the job would be calling up a customer and saying, "Oh my God, XYZ missed earnings by a penny. You should sell." Or, "Oh my God, Goldman Sachs upgraded. You should buy." And for me, with absolutely no background at all in finance or accounting or anything, I had no clue anything about the stock market. I was kind of amazed that as a 23-year-old kid who was still working as a bartender on weekends, I'd be calling up guys that were like 50 and they managed, $10 billion or whatever. And they would listen to what I said and say, "Oh, this guy says we should sell it. We should sell it." And it was just totally bonkers. I mean, I realized pretty quickly that did not make sense, that, that world did not make sense. It took me a while to connect the dots, though, and figure out that the guys who were the opposite of that, the guys who were the worst customers on a commission basis, actually made a lot of money on the investing side. So basically people that run portfolios like I do now, where 10 or 15 or 20 stocks, whatever it might be, a reasonable amount of AUM, a small cap focus, and low turnover, low trading, that sort of stuff, and just real business analysis. And I was kind of clued into that it was actually a customer of my partner's, who was a guy that worked at the Royce Funds, which is a small cap value shop I'm sure you're familiar with. And I was opining to him one day, like, how crazy I thought the whole thing was. And he basically said, "Wow, he's joking, I hope he was joking. He said, "Wow, it sounds like you might actually have a brain in your head. So why don't you use it and go read Ben Graham, go read Warren Buffett, go read Joel Greenblatt, et cetera, et cetera, et cetera." And it kind of blew my doors off. I went home that night and I started reading, and, I was probably up all night, and it's kind of cheesy to say, but it's like Buffett says, it's inoculation. You either get it right away or you never get it. And for me, it was like something I never even knew existed, but all of a sudden I found it, and it was like the perfect fit. So I began to aggressively torpedo my career because I realized I didn't want to be just, churning for commission. I wanted to be an investor, and I would go in all day and sit there, trying to do my job. But at night and on weekends, I'd be reading 10Ks and trying to teach myself how to build models. And then I eventually transitioned to more of a capital markets banking role to learn some of the technical skills like the modeling. And I went through the CFA program to learn the accounting and that sort of stuff. And then kind of reinvented myself as, what I was calling an idea generator, where my idea, my pitch was, I'm going to focus on these guys that only run small amounts of money. They don't trade a lot, but they take big positions. So if I could get something in their book, they would do the trade with me. That would generate the commissions, et cetera. With the real idea being, hopefully one of these guys will hire me one day. That would be how I made my jump from the sell side to the buy side. The problem, though, is that these guys that put up the best numbers, if you only have 100 million or whatever it might be under management, it's typically a one-man or a two-man team. And the jump from a two-man team to a three-man team is a huge jump. So I had a number of people saying, keep the ideas coming, and at some point we'll find a way to work together. And it just never really happened. And eventually my boss at Cantor came to me and said, "Look, I walk around the room and I see most of the guys sitting here, throwing a football across the room and watching ESPN, and you're here reading 10Ks and building Excel spreadsheets. Like, what is it that you're really trying to do? Because your commissions are down by like 70%. And, he basically said, "Look, would I be doing you a favor if I showed you the door?" And the answer was yes, because by that point I had become a partner at Cantor Fitzgerald. And if I had quit, I would have lost my partnership interest. But because they showed me the door, I had a 5-year runway to get paid out. That kind of gave me the foundation to do my own thing, which turned into Laughing Water Capital. I did a small stint with a buy-side asset manager in a research role. Spent some time there. I do actually feel like the research team there at Boyer Value Group was fantastic. I learned a lot from the research analysts, but I also had my own ambitions. And over the years, my interest in, just in the game, interest in the art of investing. I did a lot of things like going to Berkshire for or go to the Berkshire meeting in Omaha, going to ValueX Vail out in Colorado, and a number of events where I met a bunch of guys who had started with small amounts of capital, running concentrated portfolios. They put up good numbers, and over time they were able to build a real business. And I've always thought about it like Buffett has said, which is, you could be on a boat in the ocean surrounded by sharks, but if you have good returns, people are going to swim to you. And I mean, literally a number of guys that I know who started small and then made real businesses, and they eventually pushed me into it. Said, "Hey, why don't you do it? Your returns are good, your ideas are good. Why don't you start your own business?" And I did that in 2016. And that was Laughing Water Capital. So we're coming up on our 5-year anniversary in February. It'll be 5 years, and it's been a fantastic journey.
And so, how did you find your initial backers? Were they folks that you had known through Cantor or through the Berkshire or ValueX? How did that come about?
Yeah, so it really just started with my money and some money from my wife and some small family money. I don't really have a great friends and family circle. I never really raised money from friends and family. But what I always tried to do was write clearly about what I'm trying to do, my thought process behind my investments and my strategy and my beliefs about the way the world works in terms of realizing value. And I just put those letters out there kind of, and it started with sending them to a few people who had indicated their interest, and then they start getting forwarded around, and then they wind up getting talked about on Twitter and other places like that. So people just started to find me and say, "Hey, I like what you're doing. Would you take some money?" And I said, "Of course," subject to certain restrictions. Like, for example, I have a very sticky capital base and a very highly screened capital base. So everyone in my partnership is entirely fluent in the language of investing. And I've never once had to explain to someone like, this is what a special situation is, or this is why a small manager acting alone and just trying to stand away from the herd can outperform. Like, people understand what's going on, and I think that's super important because having a stable capital base is one of the keys, right? I mean, you're running a concentrated portfolio, you're running in small caps, volatility is real, and in those times when it's most volatile is when the portfolio manager needs to be able to think most clearly and focus most extremely on what's really going on. And if you have people calling you up saying, "What's going on? We should be panicking," it makes it that much more difficult to focus on behaving the right way. So I've totally insulated myself from that sort of risk by only taking money from people that understand what we're doing. And that comes actually with a long commitment period. So 95%, or maybe it's 98% of the LPs at this point have signed a multi-year lockup. And that gives me the capital base that I need to behave the way I want to behave, which will, over time, hopefully continue to drive outsized performance.
Let's take a step back a moment and talk a little bit about your philosophy. So we know that it's a value-based philosophy. You're currently focused in small and micro, and perhaps using special situations as the trigger to look into positions. But it doesn't sound like you're necessarily constrained to small and micro, and you're not necessarily constrained to the special situations either. So you're just looking for, along the value spectrum, something that is undervalued, to sort of simplify it as much as that.
Yeah, that's from a high level, that's a good way to think about it. One of the things I mentioned earlier, the value spectrum, I do think it's notable that I diversify across that spectrum. So there are some things in there that are definitely much more asset plays, cash-rich balance sheets, unexciting businesses, that sort of stuff. Like AMEA, for example, fits in that bucket. That's one I know you spoke with Chris Middleman about a number of weeks ago. And that portion of the portfolio, if I'm being honest, has been a notable drag versus like the bulk of the portfolio, which is the sort of middle of the road businesses that are just underappreciated and cheap for those special situation reasons. And of course has been a drag versus the more growthy edge of the portfolio. But I think it's important to think about diversifying across that spectrum, to be intellectually honest, because we all know there's a number of, I guess, for lack of a better term, famous value investors from 10 years ago or 20 years ago that have really struggled in recent years. I don't want to say most of it, but a lot of the best performers, kind of like the golden age of value coming out of the tech crash and that sort of stuff, those guys a lot of them have really struggled in today's world. And it's probably only a matter of time before the same can be said from the people that are extremely on the growth side now. one of the things I think about with some of the growth names, and I'm not short any of these names or anything like that, but you see these stocks with their 20 times or 30 times or 40 times revenue or something like that, and you need a really long DCF to justify that. And invariably, it seems like the thesis is that over time they'll get leverage on the sales and marketing line, and that might be true. But for most of these businesses too, they're really first movers, right? So they have a huge first mover advantage. There's definitely a generational shift underway in terms of cloud computing and stuff like that. So they have first mover advantage, but eventually that first mover advantage is naturally going to erode. And to me, it seems incongruous to claim that you're going to get leverage on sales and marketing just as new entrants are approaching the market. So you have to assume that at some point margins are going to really widen out. And you have to assume that those margins are going to widen out by cutting sales and marketing. But how are you going to cut sales and marketing when for the first time you're facing real competition? Now, the pushback against that is like, oh, well, switching costs are really high. And again, that might be true. I mean, there's certainly going to be some winners in this space. But I question how intellectually honest it is to claim that there's going to be super high switching costs from a company that is a disruptor right now, because the switching costs are not too high for the incumbent, obviously.
Demonstrably so.
Yeah. So, there's definitely going to be some winners and there's definitely going to be some huge successes. But I think if you look at people where their whole portfolio is these kind of, fast growing SaaS names and whatnot, I don't necessarily believe that it's intellectually honest to say that that's a strategy and a process that's going to endure for the long term, because it seems like at some point there's going to be some very natural roadblocks to those businesses. Now, so far, it's worked really well. And, I get shame on me for not being more invested in those stocks. I mean, I'm for lack of a better expression, I guess I'm picking the wrong dartboard. But for me, where I've put up returns that the prospective LP said to me earlier today, you've put up tech-like returns, but I've been underweight tech. I feel pretty good about that because I think that that's intellectually honest. And I think that this is my strategy. My approach is going to be timeless because so much of it is based on taking advantage of the failings of human nature and market structure. So, it's not every day that a Ron Perlman has troubles with his debt stack, but it happens, and it happens fairly often where you can take advantage of it. And that's not tied to any of the macro factors that may be fueling a lot of the growth success right now. So it's not tied to low interest rates. And there's some risk that many of the sexy SaaS stocks are really just interest rate plays in disguise. And there's some risk that people are really exhibiting recency bias when they assume that all these things are going to grow to the sky. Because you look at Google and Amazon and Salesforce and others that are truly dominant businesses, and people take that framework and apply it to the next company that just says SaaS in their name. And again, I'm not short any of those names or anything like that. I'm just more cautious than most, and think that for me and my partners, as I think about the next 30 years, is I want to have a strategy and a process that is repeatable and repeatable and repeatable and repeatable, and not kind of interest rate timing in disguise or anything like that, because I have no doubt that at some point there will be the next group of investors that fit into the mold we see today of, I don't want to use any names, but I'm sure we all know a number of the best value investors from the 2000s that have really struggled for the last 10 years. And at some point, we're going to see some examples of the, quote, best growth investors of the 2010s or 2020s, and they're going to really struggle. And for me, all I'm doing is trying to take advantage of human nature and market structure to find cheap securities, and that's going to be timeless, I think.
Are you explicitly thinking about diversifying across those different strategies as you're building the portfolio, or is that just something that you're sort of agnostic to what goes in and you take the opportunities when you find them?
I do explicitly think about it on the tails. So like there's always some portion of the portfolio. I shouldn't say that on both tails. It's always on the left tail, like the asset value tail. I explicitly always keep a portion of the portfolio in securities that I consider to be, more defensive, whether that's an asset value play or counter-cyclical or something. But something that should do really well when a recession eventually comes. I mean, we seem to forget that recessions are real things. I think you're Australian, so maybe you don't have any real experience with recessions. But in the States, they used to happen before the Fed just started printing money all the time. So I want to have some portion of the portfolio that is explicitly in there for defensive reasons. So you could take, for example, a cash-heavy balance sheet and a management team with a history of capital allocation. And when there's a recession, that the cash on the balance sheet doesn't actually change in value in terms of its dollar value, but in terms of its purchasing power, it goes way up. And that's really attractive. So I definitely look for stuff like that, or businesses that explicitly do better in weaker economic situations. So, for example, for a long time, I had a big investment in pawn shop companies. On the growth side, I don't explicitly seek them out, but I'm certainly aware that if you can find a great business and you can have that growth potential and you could point to a sustainable competitive advantage, you could do really well. Interestingly, though, a lot of the ones that I would have in my growth bucket kind of started as special situations pick. So just very quickly to touch on one that I own is PAR Technologies, which is restaurant point of sale software. And a fantastic CEO, fantastic product, fantastic everything. But where it was really interesting to me is that if you rewind a couple of years ago before the new CEO, the business was family controlled, and you could look at a long-term stock chart and it was basically flat for like 25 years because the controlling family was not effectively allocating capital. In many cases, they were actually, I would argue, burning capital. Like, for example, they had the founder's son and daughter, I believe it was, were running a health club out of the corporate offices. And that's not very efficient. That's just not what you want to see from a management team. But then there was some outside pressure from some activists who came in, and credit to the founding family, they did the right thing and they brought in a new CEO who's fantastic, and he's a pure software guy, and they've stopped doing those things like the health club and whatnot. But there's still kind of a special situation angle because the base business, the historic business was actually a defense business, which they still own. And then there was a restaurant hardware business, which they still own, and actually ties in very nicely with the restaurant software business. But they've said at some point, and they've openly said that they're going to divest that defense business at some point. And just looking at something like that, where, I mean, the stock is re-rated considerably, it's not cheap on traditional metrics right now. I do think it's cheap versus its growth potential and versus the capital allocation ability of its CEO. But you also get kind of this added bonus because at some point they're going to sell that defense business. And when they do that, it'll clean up the financials and make it easier for people to look at it as a pure play, make it easier for the quant models that kind of scrape the world and dominate the markets these days, and make it easier for those models to see what's going on. So that's, even though it's a growthy business and it's not cheap on traditional metrics, it's cheap versus other growth names. And it's certainly cheap when you start factoring in those kind of levers they have to pull to reveal the value to the world.
When you think about shorting, how do you go about that?
So I'm definitely long biased. I kind of look at shorting primarily as just kind of like a curiosity alongside the long process, where I don't typically set out looking for shorts, but occasionally, just in my travels, reading and studying businesses, you come across something where you say, this is something that is worth shorting or worth digging into longer on the short side. So that's part of it. And then I also maintain the flexibility, although extremely rare to use it, but more exposure shorts, where just taking down the gross of the book, because the reality is when things go wrong in small cap world, well, everyone in the stock market these days, when things go wrong, correlations go to 1, and small cap and micro cap get hit harder than anything else. So it is nice to have flexibility to use some index shorts or that sort of stuff to just sort of protect against that. There's a very fine line, I think, between market timing and doing that effectively. And I think I've stayed on the right side of that line I've really only deployed that strategy in a meaningful way once, which was back in March with COVID. And, you could look at that intellectually and say it was not market timing, because if you were reading the headlines out of Asia and everything else, you could see that it was the real potential for a big problem was there. So at the same time, you can kind of look at risk reward on getting short some of the retailers and stuff like that, where they had supply chain risk to China even before people realized that the world would be in lockdown. There was supply chain risk and something like that. And it was a very lopsided trade to be short some of those retailers, because if there were supply chain risks, then they could be in real trouble. But if there were not supply chain risks, I think it would be very unlikely that a group of retailers would all of a sudden rip higher and really squeeze you on the short, just because retail is so hated, and the obvious story surrounding Amazon and everything else. So it really just set up as a really asymmetric trade to be able to express through shorting some index products and that sort of thing, or ETF products.
How are you expressing this short? Are you actually shorting, or are you buying puts, or how are you doing that?
Both, but I tend to avoid options. I mean, very, very rare, a very small percentage of that might have been on options. Most of it is just in the shorting ETFs and that sort of stuff.
So let's talk a little bit about how you filter, validate, source ideas. What's that process?
Yeah, so I think about it in a couple different ways. One thing I don't do is any kind of mechanical screening that has valuation or something like that as an input. I'm very broadly of the view that if something looks cheap in today's world, it is not cheap because everyone has a screener and the mechanical ability to go through and find that. So if it looks cheap, it most likely has been picked over. Now, there's obvious exceptions. I mean, one that jumps to mind immediately is Apple, where a couple of years ago it was trading at a PE of 12 or 13 or something like that. So there are obvious exceptions, but broadly speaking, I didn't do any kind of price-related mechanical screening. My most effective technique beyond just reading broadly and staying curious is probably stuff like keyword search, where you can identify certain events. So I tend to look through anything like for example, a tender offer, which is nothing about a tender offer by itself is exciting, but it is an indication that something might be about to change. And the basic thought is that markets are broadly efficient. Most of the time, markets are efficient. So if you're going to be so lucky to find an inefficiency, your odds go up if you're searching for something where the matrix is changing. Something in the matrix is changing. There's an event or something happening that might explain why the market has it wrong. So there's a couple different things over the years that I've just kind of narrowed in on with keyword searches. And tender offer is a very simple one. I have a number that are much more complex and much more quirky keywords that tend to pop up in filings and stuff that will tell you things are going on. So that's a big part of it for me. And it's really just kind of continuing to sift through the world and find interesting things and be aware that situations pop up every now and again that are really unusual. The Perlman example is a good one. And you just stay aware that those things are out there and try to focus on what's going to be important. And I think it's interesting, actually, again, sticking with the Whole Earth Brands example. And I should quickly give credit to Dan Roller at Marin Capital, who I think is someone who has spent some time on that and should get some credit for being associated with that idea. But if you look even on Value Investors Club, where there's a write-up there's people in the comments section that are debating, what will EBITDA be in 2 or 3 years? Like, how successful will this cost rationalization plan be? And what will EBITDA be? And that sort of stuff is important, but I kind of look at what Seth Klarman has said about needing to have the ability to make decisions with only 80% of the information, because if you wait till you have all the information, the opportunity is probably gone. So you can look at it, and we could quibble over whether EBITDA in 2021 is going to be 65 million or 60 million or 70 million, or, we could quibble. But it doesn't matter, because you could take the low end of that and haircut it, and the stock would still be cheap versus comps. And the most interesting thing is we have a forced seller. You could look at it and say, this is a guy that from the original sale price, which Perlman is known as a hard negotiator, the original sale price, we have to assume that he was under some pressure then, but the original sale price was 575 million. And then after everything that's happened, this de-SPACing process, the COVID effect, everything else, the shares are available for like $250 million market cap. So it's less than half of where Perlman was originally selling it. The odds are heavily in your favor at that point, that even if the execution isn't perfect, as the story unfolds, as the stock gets added to indexes, because it's not in indexes yet, as Irwin Simon goes out and does his thing. Keep in mind with Irwin Simon, he formerly ran a $2.5 billion revenue company. He is intimately familiar with the way the sell side works. And even though this is now only, I think the market cap right now is called 300 million. Even though this is only a $300 million market cap, Irwin Simon has behind him a long track record of doing M&A. And the banks certainly know who he is, because they know he's been a good customer to him in the past. So now if he could go out and say, hey, I am probably going to do some M&A here at some point, but how about some research coverage? And all of a sudden you could have some real banks shining a light on a stock that nobody else is looking at. And I think those sort of factors are more important than deciding if in 2021 EBITDA is going to be 65 million or 60 million. What's really going to matter here, at least in the near term, is how those dynamics shake out and how the fact that Ron Perlman was a forced seller kind of develops. clearly, as we go on through the process, we need to re-underwrite and change and check our assumptions constantly, and always try to be updating for the current valuation and stuff like that to see if this has the potential to earn a long-term hold in the portfolio. I mean, there are situations where this could be a stock that you own for 5 or 10 years. I mean, it's not crazy to think that if they get the right cost of capital, they could use this as an M&A platform. And it's interesting to think actually that the insiders, their shares from the SPAC are locked up until the stock hits $20 a share, and the stock right now is at $8. So, those are things that could justify a long-term hold here. We're not there yet, though. It doesn't matter. The 65 million in EBITDA next year, or the 60 or 55 or wherever it might be, is less important right now. It'll be more important a year from now, but right now, focusing on those things that are just outside of true economics, they're just kind of quirks in the world, are the kind of things that can drive performance.
So that's some discussion there about how you're validating the ideas. But are you doing channel checks, speaking to management teams? How do you validate the idea?
Yes, definitely all of those sorts of things. I mean, it's a bottom-up process, starting with reading the financial statements and the transcripts. I almost always speak with management teams. I don't always, but I almost always do. I try to speak with former employees, that sort of stuff, competitors, read the filings on the competitors. I don't really do any sell-side research. I don't really use that. It just doesn't really fit well in my process. And basically just turning over as much as I can, trying to get to the real, the thesis, and then trying to destroy the thesis by questioning all the things that I've come up with through my first round. So if you think of the initial round as financial statements, transcripts, management, and then you'll be able to paint the thesis with that. And then you try and destroy that thesis by going to things like competitors and customers and former employees and say, what is the truth from the outside versus what the truth is as they projected through their financial statements. And then the last part of it is something I call a red team. And because I'm a one-man show, I don't have a partner or anything like that to help me realize the flaws in my thinking. But what I refer to as the red team is actually an idea that was put together by Scott Miller at Greenhaven Road, who you may be familiar with. If not, you should probably try and speak with him at some point. He's a fantastic investor and great human being. But he, about a year or two ago, brought together a number of like-minded investors to do an event with Annie Duke, who has written books about decision making. She's a former professional poker player and psychology. Because she almost had a PhD in psychology. She dropped out to play professional poker, but she's an authority on decision making, I guess. And basically had an event trying to explain how decision making works and how, as investors, we can improve our process. And one of those things is being aware of your own biases, and the second thing is being aware that you can never fully defeat them. So the red team idea is if you take other people that have a similar but different skill set and have them look at your ideas with the idea that in advance, we're going to make an agreement that nobody's going to get their feelings hurt here. The idea is that you would make me uncomfortable. And so there's a number of other investment managers I can rely on for that. And where I actually feel like I have a real advantage is that when I think of Laughing Water Capital, the largest cohort within the LP base is actually other professional investors. And that's everything from, former equity managers or current equity managers that used to have a small cap strategy, but now they have too much money to invest in small caps. So they invest with someone like me while they also run their own portfolio, or private equity types, where a lot of times I hear from private equity investors that in their world, they're always buying from the smartest person in the room. But in my world, I'm often able to buy from the dumbest person in the room. But the point is just a network of people who are LPs, and their incentives are on returns just as mine are. So they're not afraid to tell me I'm stupid. And that's really the goal. I don't want anyone to tell me that my idea is great or that my idea is correct, correct in quotes. What I want is pushback to help me understand what I'm missing, what I'm doing wrong, other things I need to think about, how the thesis needs to be adjusted over time to the things in advance that would make me change my mind. All of these things are meant to defeat the demons that we all have, which control our behavioral response to decision making.
What's the source of that red team idea? Is that like a Bill Belichick? Does it come from Pats? Is it something like that? I remember reading it maybe in the last year or two. I'm
not sure. I mean, as much as it's painful, I'm a Jets fan, so I can't really comment on Belichick or the Patriots. But for me, the first time I had heard it, or at least got intimate with it, was through this event with Annie Duke. So from my perspective, I would credit her. But it's definitely possible it came from somewhere else.
Just for fun, just we're coming up on time here. What's the source of the name Laughing Water? It's a great name.
Oh, thank you. It's well, kind of the joke in the hedge fund world is that you name the fund after the street you grew up on or something like that. But I grew up on Homestead Avenue, and there's already like 10 different Homestead funds, so I had to dig a little deeper. And my family has a small place on the North Fork of Long Island in a community called Laughing Water. And kind of the right way to think about that is, cornfields and a hammock and a book and just thinking and reflecting and, kind of letting the world come to you.
Why is that place called Laughing Water? Is that something like you let the corn, put it in a still for a little while and out comes laughing water?
Well, it's funny because there is a connection. Well, for this specific Laughing Water, it's actually a Native American link where Native Americans that had lived there at one point. There's a creek there. But in terms of also being an Irish American guy, the Laughing Water connection to whiskey, in the Gaelic world, the Wishkahela, I think actually means laughing water, which has always been a source of jokes, but it's very much the Native American attachment from where I got it.
It's absolutely fascinating. Thanks very much for the time today, Matt. If folks want to get in contact with you, how do they go about doing that?
Yeah, the best thing to do would be to go to laughingwatercapital.com, specifically the letters section. You could go there and review past investment letters and past investment pitches I've done to kind of just get an understanding of how I think. And there's also a button there that will allow you to sign up for a distribution list. And then I'm not very active on Twitter, but I am on Twitter under, I believe it's Laughing H2O Capital. And that's the best way to do it.
That's fantastic. Matthew Sweeney, Laughing Water Capital, thank you very much.
Thanks very much, Toby. Appreciate it.